Hi, everyone. Welcome to NEPC's first quarter webinar, where we'll be covering our current market outlook. I'm Jen Appel, and today I am joined by my colleague, Nina Petkova. Before diving into the presentation, there are just a couple of logistics to cover. First, that if you have any questions during the session, which we certainly hope you do, please enter them into the chat box on your screen, and we'll hold some time at the end to go through those. Second, if you'd like a copy of the slides or a recording of this presentation, those will be available on NEPC's Insights page shortly after the webinar. So just in terms of content today, we'll be running through an overview of what happened thus far in 2024, kind of looking at the state of the market. Then we'll dive a little bit deeper on Fed policy in light of recent inflation data. And then finally, we'll wrap up with our views on portfolio positioning, and Nina will provide some thoughts and detail on public equity implementation as well. And with that, we'll dive right in today. As we look to returns across major asset classes to start 2024, it's largely been a story of strong performance coming from risk assets and equities in particular. And while the S&P is once again the best performing asset among this group, there were notably strong returns posted across global equities as breadth expanded across the cap spectrum and to different geographies as well. Now, we view this performance as a reflection of the continued strength we've seen in the US economy, which has supported consumption and corporate earnings, but also has caused a lot of these lingering questions around if or when we might experience a recession to recede. And as those recession concerns have gotten pushed farther into the distance, there's been some upward pressure on interest rates as the market is kind of reassessing what that path looks like going forward. So you can see that weighed on returns across the fixed income complex, but especially in some longer duration segments. These dynamics also then flowed through to the real asset space. It was a strong quarter for energy and broader commodity returns as that stronger than expected economic backdrop influences the demand outlook, while some of the ongoing geopolitical tensions have impacted more of the supply side of the equation. This is something that we're going to talk about a bit more in terms of inflation, but further pressure here certainly poses a risk for headline inflation measures. So that is something just to be mindful of moving forward. Now, if we dive a little deeper into the equity story, the S&P 500 index increased over 10% in the first quarter of 2024, which ranks among the best first quarters for the index since 1970. And as we look across many of these historical data points, the pattern is typically that when we have such a strong start to the year, that the rest of the year tends to be positive for performance as well, with kind of the notable exception of 1987 that has the October market crash dragging down the remaining year bar there. So at the surface level, it looks like the rally and market optimism that we saw to end 2023 has continued. But if we actually look to the underlying composition of performance and some of the factors that have been driving this rally, the narrative has been quite different this year. And as we think back to the story from last year, there was this very bifurcated market where it was almost like the Magnificent Seven names versus everyone else. This meant that the biggest names were contributing an outsized portion to returns, as a lot of those companies were able to meet or even surpass lofty revenue and earnings growth expectations from the market. So coming into 2024, we did feel that that was a risk to US large caps, not only because of the concentration issue, but also the fact that those top 7 names were in many ways priced to perfection with expectations that those outsized growth rates would persist. And then January, we did see some of that trend continue where the mega caps were leading the way. But as we moved into February, March, even April, breadth started to broaden out in equity markets where we had more names doing well. So equal weight or even value indices, some areas that maybe didn't have quite the same degree of performance in 2023, they were posting strong returns to start the year. So today we have a much more broad, more balanced story that's emerged in US equities, which you can see in the changing return profile here. Now, if we decompose the S&P index return a little bit further, you can see that outside of the Mag 7, the rest of the index is returns to start the year. But even with that, the top names are still having a large influence. And a lot of this we think is tied back to artificial intelligence, or AI, which was a theme that we profiled at the start of the year. We still think that that's kind of the dominant undercurrent at play. But today we are seeing some divergence even within the Mag 7 names, as some updated AI related guidance drove returns for a narrower set of companies versus that kind of broad AI momentum that we saw last year. So there's quite the range of quarterly returns here within that group. On one end, we have NVIDIA still kind of dominating the scene and even having some network effect in terms of driving performance for other related companies, albeit most of the strong performance came in the first half of the quarter. And the stock has been under a bit of pressure as of late. While we look to things like Apple and Tesla, they're on the other side of the spectrum and are actually detracting from returns. So a bit more dispersion even within this group. And maybe we should be testing out a new name rather than the Mag 7 if this dynamic continues. Now, if we think about all this moving forward, really it all comes back to earnings. Earnings and earnings forecasts are ultimately what will drive the market. Looking to expectations today, they are quite bullish. There are some pretty high growth figures expected, especially this year for the Mag 7, that may prove to be a high hurdle for these companies as investors are still waiting for more of the proof statement around AI. With that said, we've already seen some of these 2024 expectations come down a bit since the start of the year. To be fair, that is a pretty typical pattern where estimates are maybe overly optimistic to start the year and they get revised a bit lower. But if these numbers were to come to fruition, or if earnings are even able to grow faster than expected, that's a way that we could see a meaningful path higher for the S&P this year. So that is one outcome of many we could see over the next 8 months, but it really comes down to this path for earnings relative to expectations. And one other note here, when you look at the expectations for next year, for 2025, they are still robust, but it's a bit more balanced between the Mag 7 and the rest of the S&P. And I think that hits at kind of the key question here, whether this earnings momentum can continue broadening out in a more sustainable fashion. Will we see other stocks, other sectors delivering on earnings growth this year? And if we do, that would support some of the breadth we've seen in the last few months versus having the gains more localized to just a couple names. So while we've seen this very strong equity performance and strong earnings trends to start the year, this has been very disconnected from the changes that have happened in market interest rate expectations. As I'm sure many will recall, essentially everything rallied sharply at the end of 2023 as the market started pricing in this pretty aggressive path lower for rates, given some slowing inflation data, but also the signaling from the Fed at year end that we could start to see rates coming down in the near term, to the extent that at the beginning of this year, 6 rate cuts were priced in for 2024. And at that time, we were concerned that the market had overdone it in expecting such a dramatic shift lower by the Fed when economic data was still quite strong, and maybe we weren't exactly out of the woods yet on inflation. So over the last few months and even through April, many of those rate cuts have been squeezed out, such that now the market's expecting about 2 cuts for the remainder of the year. But this is certainly something that will continue to evolve as we get new data and new guidance from the Fed. Now we'll walk through this in some more detail shortly, but we have had a few stronger than expected inflation prints in the US to start the year that have really been a driving factor behind that change in rate expectations. The data suggests that this kind of smooth path back to 2% Fed target inflation levels, that's not super likely to happen. And in fact, if current trends continue, we could be on a trajectory higher for inflation, especially given a lot of the muted prints that are there in the back half of 2023. So this very much conflicts with the bias that we've seen by the Fed and by markets for interest rates to be cut in the near term. And I think this data also introduces a bit of uncertainty for the Fed in terms of how successful they've actually been in fighting inflation. So all eyes are likely to be on the next few prints, since those will be an important factor in determining whether we get rate cuts this year. Now, ultimately, all of those higher rate expectations and inflation figures flowed through to the US Treasury curve. We saw US rates pushing higher during the quarter, with some more substantial changes in the middle and kind of longer end of the curve, with certain points being up 30 to 40 basis points. And there's even been a little bit more upward pressure in rates in April. So this has broadly been a headwind for fixed income returns to start the year. But if we look to credit specifically, there has been kind of a decent amount of tightening in option adjusted spreads across most credit qualities. And in some areas, especially within high yield, spreads are approaching all-time lows. A sign of concern for investors, as spreads are a meaningful contributor to the all-in yield for credit. But when we look at spreads as a percentage of the total yield today, they're not as big of an influence given that the risk-free rate is elevated. So because that base rate is a much larger portion of the total yield, that can support the carry profile even with tighter spread levels today. Beyond that, when we think about forward rate expectations, the market's bias is for rates to come down. So thinking about spreads on a forward rate basis, they don't look quite as richly priced today, which is just kind of a different valuation metric to look at. But even with that context, spreads are low today, and we do think it's prudent to be more cautious on the entry point for high yield with that in mind. Now, finally, pulling all of these elements together, as we think about this macroeconomic backdrop with the risk of stickier inflation and potentially higher for longer rates, we want to be mindful of how inflation might impact various aspects of portfolios. So here we have some data showing that historically higher inflation rates are associated with lower default rates, which intuitively makes sense as inflation is good for borrowers because debts are declining in real terms. So with that in mind, high yield or credit more broadly may not be a bad spot to be in from a strategic standpoint, given that carry aspect coupled with theoretically lower defaults in this environment. But again, the level of spreads today does temper our excitement on the near-term opportunity. So that concludes kind of the look back of what happened this quarter. We did want to switch gears and go through a few slides focusing on the Fed's messaging and their bias to ease policy relative to what the economy is telling us. Now here we have just a few quotes on screen to show the evolution of the Fed and Jerome Powell's comments on the direction of policy. As we think back, this easing bias really accelerated at the end of 2023 when the Fed started talking, admittedly maybe a little bit prematurely, about cutting rates and being at the peak policy rate. And the market obviously took that to the extreme. But almost every single message or takeaway over the last few months has been reinforcing this narrative that inflation's on a path lower. Even if we have some bumps in the road, things are coming into better balance, so it'll be appropriate to lower rates this year. And I think many were confused by this messaging, as we still have very easy financial conditions, actually easier than when the Fed started hiking rates. There are tight credit spreads, strong equity markets, low VIX levels, and so on and so forth, pointing to the fact that the economy is pretty good, but also that policy may not be tight enough. And that's likely part of the motivation for Powell's comments earlier this week that saw a little bit of softening in the language about rate restrictive for longer given the new inflation data. But it certainly wasn't a hawkish message that we heard. There was no mention of raising rates, and we still believe that this bias points to easier policy than not. But this shift in tone may be a sign that if we start to see some weakness in the data, they could jump at the chance to cut rates even faster than they might have previously. But I still think that idea of cutting rates seems pretty disconnected from the recent growth and inflation data we've had. For those that have followed on our webinars over the past couple years, we've talked a lot about inflation. And I think it's fair to say that we are still more concerned about inflation than the market is, especially if some parts of the economy are recovering or re-accelerating, as some of the recent manufacturing data might be pointing to. That could signal more inflation pressures, which would undo some of the progress that the Fed's made. So we showed CPI earlier. Here's another inflation metric with core PCE, which is the Fed's preferred inflation measure that excludes food and energy prices. Looking at this, it doesn't suggest that we have a trend with inflation moving lower. And in fact, inflation is probably a lot stickier than what the Fed is hoping for. So this brings about some questions. Will the Fed ignore their inflation target and move forward with rate cuts if nothing really changes here? I think we also have to ask, if this trajectory for inflation continues, will the Fed cut at all? Or if this accelerates further, could we get a hike? These are all outstanding questions at this point. But the path with no rate cuts, or even this idea of a rate hike, is definitely not one that the market's pricing in. So that could be a source of volatility and a potential surprise for markets if it were to happen. Now, one other way to just put this in context, there is this outstanding concern that we could have a second wave of inflation. This isn't to say that today's path for inflation will follow the exact pattern that we've seen in the past. So I wouldn't read this as a call for 1980s level inflation, but this has happened before, and the potential for this dynamic will be in the Fed's mind, and it could inform decision making for them, as this is one of the risks if they start to ease too soon. Now, we did want to look a little bit closer at what's driving the recent pressure in inflation. It has been more of a broad-based increase as of late. For a while, it almost felt like we were playing inflation whack-a-mole, where we would see a stronger print coming from more of a one-off category, whether that was used cars or some insurance category. And then the market could explain away the data point with supply chain issues or calculation weirdness. And next month we were looking at a new culprit. But we've seen less of that dynamic at play and more of these broad price increases coming through for a wider swath of the inflation basket, including energy, which had been on average a detractor over the last year. And just a note on that, as I mentioned up front, there has been some momentum building in the broader commodity complex from geopolitical tensions, but even some weather patterns disrupting supply, among other factors. So as those prices start to pick up, that is eventually passed through to other parts of the economy as well, whether that's food or transportation or goods. So that doesn't bode well for inflation in the coming months, especially if the economy continues to be resilient. Then we could see some kind of good cyclical inflation pressures building as well. I also think it's important to remember that we're still seeing momentum in these quote unquote sticky inflation factors too, like shelter or core services. Shelter has a lot of well-publicized issues, including the notorious lag, but its decline has been a bit slower than expected given some of the supply-demand imbalance that exists in the housing market today. And then if we strip away shelter, core services prices are also ticking higher. That's really kind of the key here. They are highly sensitive to the dynamics of the labor market and wages. And as we look to a lot of the data coming out of the labor market, it's been fairly strong. We're still seeing a lot of jobs being added on a monthly basis. Many of the claims figures are benign. Even the size of the workforce is increasing, and wage gains are also still continuing at a healthy clip. So if this continues, this can keep the economy and the consumer spending, and that stickiness in wages can also keep the inflation engine running. So this dynamic means that it could be less likely we'll get those rate cuts later this year. Now, bringing all of that together, you've heard this bias from us to a higher interest rate, higher inflation path than what the market's pricing in, given the resilience we've seen across the economy. And as mentioned, the labor market is truly at the core of this view. So in our minds, barring some big dislocation in the labor market or some exogenous shock, we still think it's unlikely that the economy is going to experience a recession this year. And if that holds, we think it means the Fed is less likely to cut rates this year, especially given how easy conditions remain today. So with all of that in mind, just a few high-level portfolio implications to highlight that we see based on these market conditions. From an equity standpoint, we have two recommendations here, one that Nina is going to talk about in a little bit more detail, but we think global equity strategies are still compelling, and we want to reaffirm the potential benefits of active management, given the macroeconomic backdrop that we just walked through, but also the broad opportunity set in the space. And second, we continue to see the benefit in adding value-oriented exposure to complement a U.S. large cap portfolio. So we are recommending an allocation of 70% exposure to the S&P 500 and 30% exposure to value for U.S. large caps. These are both areas that we think will benefit should we see more of that continued momentum in the broadening out of equity performance. Then from a rates perspective, maybe not the most exciting thing on the page, but cash rates are still attractive. So we are comfortable holding excess cash levels as part of your safe haven exposure for liquidity needs or rebalancing purposes. But important to note that we still do want portfolios to have the appropriate level of duration and even diversification within that broader fixed income bucket. And lastly, just thinking about this investment regime, and in particular, the potential for upside inflation risks stemming from geopolitics or even some of the factors that we've walked through, we think this is a good time to consider diversifying real assets exposure. Now, specifically, is that profile well during times of elevated inflation and positive nominal growth, we see value in the real asset space. You will often get an elevated inflation beta through existing exposures, especially within the public equity space, but traditional stock bond portfolios are often disrupted when we have higher levels of interest rates and also inflation volatility. So the diversification benefits that come with real assets are really what kind of shines in these types of environments. To be clear, this is not something that will fit in every single portfolio, so it is important to understand the context and the portfolio need for inflation sensitivity, but we do see this favorable macroeconomic environment that can bode well for real assets. And also important to note that many of these assets have a high real carry rate, which is attractive as well. Beyond that, just one quick note on tips. We are still recommending investors add strategic exposure to US tips. With the normalization of interest rates over the last couple of years, we still see relatively high real rates, along with decently attractive break-even inflation rates that maybe still don't reflect all the upside potential in inflation. So we see benefit in having dedicated strategic tips exposure, especially for portfolios with larger fixed income allocations. As mentioned, we are recommending investors look to increase exposure to active global equity strategies. This is a space that we continue to see an attractive alpha opportunity that Nina is going to get into in some more detail, but it truly gives investment managers some flexibility relative to the constraints of the benchmark. And from a beta standpoint, there is a lot of dispersion at the country or sector level, and by going passive or being tied to the benchmark, you own all the good and maybe all the not so good that can come with that. So this dispersion really provides a good playing field for managers to add value and to be flexible and over or underweighting certain pockets of the market. So with that, I'm going to now turn it over to Nina to provide some thoughts on equity implementation.
Thanks, Jen, and hello, everyone. My role in the webinar today is to talk about NEPC's views when it comes to equity implementation. And we realize that equities are a cornerstone of return generation, and in this sense, play the role of an engine for a portfolio. And so as such, this segment often represents a sizable allocation. So positioning and making the right implementation decisions really matter, which is probably why I was invited to be part of this quarterly webinar today. When we look across asset classes within marketable equities, there is a bull case for active management across many spaces. The current market environment with reintroduced volatility as we essentially moved away from 0% interest rates to a new market regime is supportive of that. We believe that skillful active managers can take advantage of dislocations that present themselves while also layering in a risk management to help stay out of frothy areas. What you see on the slide is NEPC's active versus passive analysis. Two tests make up our assessment. We review for dispersion between manager returns in the universe and also check if the average, median, rolling 3-year excess return is positive or negative. As you can see, there is plenty of green on the slide. And some of the takeaways are that active management tends to be more attractive for broader markets, such as global and ACWI ex-US versus EFA large cap and EM large cap. We also see that there's significant dispersion in smaller cap spaces, US small cap, ACWI ex-US small cap, and emerging market small cap, confirming that those areas can be alpha rich as they're less efficient and therefore specialized manager skill can be integral. Jen mentioned global equities, so I want to spend some time talking about the opportunity for clients. We at NEPC have been proponents of global equities within the portfolio structure, in addition to exposure to the distinct US, EFA, and EM sleeves, as we think there's an efficiency and inherent diversification that can be gained. This concept of a broad opportunity set providing an attractive alpha advantage, assuming manager skill, of course, is supported by research, and we all remember the fundamental law of active management from our CFA curriculum. Utilization to global mandates can help investors outsource US versus non-US in that decision, optimizing overall performance by considering the interactions there. There also is inherent flexibility to invest across more regions and countries, adapting to changes in market conditions and for managers to take advantage of new investment opportunities as they arise. It is also important to remember that not all companies have clear guidelines when it comes to the country of origin and main market of operation and revenue generation. Names considered American may be headquartered elsewhere, and even companies based in the US may derive most of their revenues internationally. Things are not clean cut, and frequently some of the lines are blurred, helping support a globally oriented mindset. I included some examples on the slide in front of you, but perhaps the best and sweetest example, in my opinion, is Ben & Jerry. Since the year 2000, the company has been an autonomous subsidiary of Netherlands-based Unilever. But as we know, production remains in Waterbury, Vermont, using mostly locally sourced ingredients. And so to a large extent, really maintaining the US consumer and shareholder values. There are so many more examples, but really the bottom line here is M&A and cross-border ownership changes present additional implications for your respective industry and sector exposures, pointing to this view of where active management can benefit from having a global mindset. And so I hope that as you enjoy your favorite ice cream flavor this summer, you are reminded of the value of global equity. In talking about global equity investing, I have to add a few disclaimers. We're talking about actively managed approaches, and so manager selection is important, but you already knew that. Provided the broad scope, I think awareness and visibility of any portfolio geographic and style biases is also important, and reviewing your marketable equity segment on a regular basis can be helpful. So make sure you're utilizing your consultant and also NEPC's portfolio construction team to help you with that. And the last implementation consideration I want to cover is preference for quality bias as an additional place to find resilience and add a layer of risk mitigation. When we say quality, you should think stronger balance sheet, stable margins, better cash reserve, self-financing, or less debt, which today we know it comes with financing costs. And I want to draw a distinction. Style boxes are not meant to be thought of in isolation. You can have a quality growth and also quality value investment approach. Additionally, the word quality is more prevalent today than in the past when it comes to finance and investment context. We have machine learning to thank for measuring that. But the bottom line is make sure you scrutinize a manager's claim to have a quality bias. In fact, our work is a way to assess substantial biases and really confirm true alpha or manager's skill can help. Finally, what worked well in the last market regime might not be what continues to work well. So take the opportunity to rebalance. Also look at asset classes away from concentrated big tech names into some spaces that have sold out as one way to further diversify equity risk. Growth investing flourished over the past decade due to a combination of low interest rate, low inflation, and central bank QE. But in the current environment of higher rates and inflation, US value stocks look quite inexpensive. We also know that behaviorally, it's sometimes hard to see value of diversification unless in the rear view mirror. And so I'll end by saying this was a very condensed version of our thoughts and considerations for investors. And so with that, Jen, I'm going to turn it back to you.
Great, thanks, Nina. So that concludes our prepared comments for today. We have had a couple of questions come in so far, but we'll give another minute for folks that would like to submit one. In the meantime, just a quick commercial for our client conference later this year. We're very excited and looking forward to having many of you in attendance this September in Boston. So please stay tuned for more details on that front. So now we'll kind of open it up to questions. I want to say thank you to those that submitted. I'll take the first one here. There were a lot of these top-down comments on US economic resiliency. How is that influencing your thoughts on the US dollar? So thank you for the question. The dollar trend has been obviously quite strong this year in particular. I think a lot of this is a reflection of the divergence in central bank policy that we've seen around the world, where some countries and regions have started or are planning to cut rates as they're battling struggling growth, while the US has been a little bit different. We still have the strong data and we still have pretty sticky inflation pressures. So the result has been this situation where US rates may stay relatively high, and then the dollar kind of becomes more of a carry trade. So with that, I think there is a path where we could see the dollar stay strong or even strengthen from these levels. So that's something to be mindful of with portfolio currency positioning. I should also mention that this is a topic we've been discussing a lot internally, and I expect that you'll hear more about this on the Q2 webinar, just given some of these dynamics. So I hope you'll all join us for that. Moving on to the next question, I'll give this one to you, Nina. Global equity is a top idea for NEPC, and you've highlighted some of the benefits of investing in the space, but could you talk about some more of the considerations and what investors should be mindful of?
Yes, absolutely. And I want to be careful not to be making any broad brush recommendations here. We realize that every client has distinct objectives and sort of a different view when it comes to their equity positioning. I wanted to state that we're supportive of global equity as an additional sleeve on top of US EFA and EM sleeves, But of course, there may be situations where smaller portfolios may find efficiency in only utilizing global equities, or there's committees that may be more willing or open to move to a structure that's anchored around global approaches and sort of supplemented by say, small cap alpha rich spaces. As with everything else, there are considerations. And so committees and clients may prefer more focused strategies where they have greater control and tighter bands rather than the broad active global equity. Also having distinct sleeves allows for more tailored investment approach and better alignment with specific goals or risk profile. For example, the ability to control EM exposure rather than allocate that decision to a manager. Just something else to think about, and thank you for the question.
Great, thanks, Nina. I think we'll take one more, and there is a question about high yields. We talked about this maybe being a more muted opportunity today because of spreads. Could we elaborate a little bit on our thoughts on the space? So I'll take this one, but a lot of my comments so far were kind of focused on the fact that, yes, we've had spread compression, and that certainly influences the entry point and how favorable we think it is for high yield. But what is interesting, if you look at the data between index level spreads relative to some of the individual credit ratings, they are a little bit different. So for example, triple C's, or the lowest quality rating, there are more distressed companies in that space. Their spreads are actually a little bit above historical lows. So with that in mind, a lot of the things we talked about in terms of the economic backdrop and inflation, and you couple that with good issuance and high yield market fundamentals, that's a spot that we think we could still see triple C spreads tighten a little bit further. And if that were to happen, clearly that would have some influence on index level spreads. And it's likely we could see spreads continue to grind lower if it comes from that triple C space. So in that situation, you definitely see more caution from us on high yield if spreads were to go lower from here. But today, we still think that the carry is compelling, and we're not recommending investors sell exposure if you're at or below strategic targets, because we still do think that there is a long-term strategic case for high yield exposure. So I think that is all for the questions today, and we'll wrap up there. Thank you for everyone that joined today. As mentioned, we will have this webinar recording and slides available on NEPC's website shortly. Thank you.